Hey guys, I want to make a quick video for you here on the yield curve inversion that we're having right now with the 10-year and the 2-year. Let me share my screen. So this is pretty important. You started hearing a little bit on the news, if you were paying attention, that you had the 5-year and the 10-year were inverting, or you might hear about the 10-year and the 30-year. But one of the indicators the Fed is looking for is the 2-year and the 10-year yield curve inverting. Now, the issue with that is who wants to take the risk of having the government pay you back 2.3% over 10 years when you can just get a 2-year treasury with the same interest rate and way less time, right? So it's similar when you go get a loan from a bank for maybe a home or a car, right? The longer the term that loan is, the more risk that the bank is taking, so they charge you a higher interest rate. Well, that's how this works as well. So when you start to see the 10-year and the 2-year invert, almost every single time this happens, we have a recession. So I would say the probabilities are extremely high we end up in a recession. In fact, I think one of the only other times that has happened and we didn't was in the 60s. In 2018, we were very, very close. So I would think we were just about to go into recession. Of course, the Fed had to turn around and start lowering rates to try to keep that from happening. So, I mean, technically, we were heading into a recession at that point. But anyway, let's take a look at this chart. I want to bring up the 2-year here and compare it to it. And I want to pay attention to these dates. So we can see the 2-year here in this turquoise green color and the 10-year in blue. And if you look at the bottom of the screen down here, hopefully you can see this well. You see in 1989, we had a similar situation, right? Well, in 1987, it doesn't quite go back that far on the 2-year, but in 1987, we had Black Monday. And ultimately, that led to this crisis here, and the yield curve inverted. Now, if we go to the 90s, I remember my parents at that time. I was I don't know, 10 years old or so, and I remember them talking about, I might have been 12, but talking about buying a home. During this period, we were having a housing crisis in California, and they were looking for their opportunities to buy. And then in 1997 or 98, I think we had the long-term capital crisis. The whole world was about to fall apart as a banking situation was blowing up. In fact, I think that had to do with Russia. Someone can correct me in the comments if I'm wrong, but I know Jim Rickards, so he's someone that I listen to as well, and I do recommend people listen to him. Incredibly smart guy. He was with Long-Term Capital at that time, and he was one of the people who helped with getting this bailout rolling forward at that time before the banking system collapsed. But also, we look down here, we know what happened in 2000 to 2001. We have the dot-com bubble. Alan Greenspan ended up dropping the interest rates to 1%, which we know what happened after that, right? You had this housing boom, and then we had another inversion of the yield curve, and in 2008 had happened. So the only other time this got very, very close, we started having a repo crisis in 2018, and we should have been going into a recession right there at that time. But the Fed, remember, they were raising rates already, very slowly, of course, like 0.25%, which is kind of a joke. But anyway, they got to about 2 or 2.5%, and they had to pull back. The whole banking system was about to collapse in 2018. So, of course, they started buying mortgage-backed securities, all this stuff again. And that brought us to the situation that we're in today, right? They printed all kinds of money. And now we're starting to actually see inflation, because when they issue that currency to individuals, you can go out and spend it. It's not like, doing a bank bailout where it might just increase the wealthy, or Well, I guess a lot of people have 401ks, right? And anything that they're holding eventually kind of trickles into there. So maybe they did okay during that time, but um, what they did this time was actually put money in the hands of the people, or currency is really what we should call it, in the hands of the people. And that changes the velocity and how quickly that flows through the system. Well, then you start to see that price inflation. Now, I'm not talking about monetary inflation. Monetary inflation, really, that's the true definition of inflation. Like, we got to start getting this right. The definition of inflation is the expansion of the currency supply. That's what it is. It's not rising prices. That was changed in, like, I think in around 1991. You can go back and find older dictionaries, and you'll see what the true definition was. And it was just this convenient change. And some dictionaries still to this day don't have um, rising prices as inflation. So it's kind of interesting. I think it's a way to manipulate things, right? But anyway, um, they changed also how they calculate inflation compared to how they did it in the 70s. But what that is doing is putting people in a situation where, why would you buy a US Treasury, right? If it's 2%, and let's say their number is right at 8%, which we know it's definitely wrong. They change the calculation, they come up with all these crazy ways to make it seem as if inflation is only 8%, right? It is much higher than 8%. I mean, clearly. So, anyway, um, why would you buy a 10-year treasury? Let's say it's at 2%, when inflation is 8% according to the government's numbers, then you're losing 6% a year, right? It's a guaranteed loss. That's crazy. So that's what you're experiencing right now. So if you look at this chart, we're hitting that point right now. So the question becomes, does this roll over quickly? Now, understand that you typically hear on the news that we have a recession. We have a recession when you have 2 quarters of negative GDP. That's what you'll start hearing on the news here. The question is it 6 months? Is it a year? Right? They need 2 consecutive months for that to happen. But that's when you're officially in a recession. So technically, you can consider yourself in a recession earlier if you could read the writing on the wall. And I would consider this writing on the wall. So taking a look at these, again, if we even use the RSI here, which typically you're using with your stocks, you can see where this has been trending, and this has been gaining for quite some time, right? I mean, you can see back here, this was already on its way up, right? It was building this strength. Now, I don't think the Fed can raise rates much higher before they just absolutely blow this thing apart. And they may want that in order to try to kill price inflation. Maybe they do that. I think Biden's in an odd situation right now. I don't know what he's going to do, because you have elections coming up. If you kill inflation, or attempt to kill inflation by crushing the market by raising rates, well, the government has to pay for their stuff too, right? So what are they going to do? Borrow money, create monetary inflation, and you're going to, I mean, it's a cycle, right? It's just going to keep happening. But let's take a look at the 10-year treasury here. So they minus the 2-year treasury out of it. So this is from the Federal Reserve's website, St. Louis Fed. They have some great charts on here people can take a look at. But the same type of thing, right? We go back to these dates here. This is basically an inverted version of the other chart. And you can see those same time periods, and these gray areas are your recessions. So when you look, when that yield curve inverts shortly after, you have a recession. So going back to, what do we got here? 1976, you can see every time this happens, recession, 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 dips, recession, dips. This is the 2008 crisis, recession. The only time it didn't was, well, at least on this chart, was the 2020 pandemic crisis, right? You had this little tiny, oh, we were in a recession, but it's over. And really, we technically probably were starting that in 2018 if they didn't just start printing money galore. But anyway, it looks like we are heading back into this situation where you really want to be paying attention to what types of stocks you're holding. Many stocks have already just gotten just crushed. I mean, matter of fact, let me pull up real quick here. Just one as an example. Big name, right? Netflix. I mean, look at Netflix. I think this is what's going to happen to a lot of these stocks right now. We are down, or we hit a bottom, at least for short term, 51%, right? And that was from November 2021 to today. I mean, that's pretty short term, but just got crushed. We're still down 45%. Now we're at the support zone here, but you're starting to see a lot of these stocks in that situation. And matter of fact, if we go look at the S&P 500, I might still have some old drawing junk on here, but we can take a look. If we look at so these are the S&P 500s, the stocks within that, right, that are down X percentage, right? So if we look at this, only, where are we at here? Right around 55%. So 55% of these stocks are just, man, they're below their 200-day moving average. Or actually, I think they're above on this particular one. I've changed this since one of my other videos, but this is pretty bad. Every time you see these huge dips, I know someone's going to point this out. They're going to say, yeah, but look at the trend you have going here. Maybe this is the end. Well, with some of these stocks, that may be the end, right? You can go shopping right now with some of these, and they're down 50, 60%, and their PE ratios are becoming pretty realistic. So individually shopping for stocks, I think, is the wise thing to do right now if you were going to hold U.S. stocks. But just remember, they're denominated in U.S. dollar. So if the U.S. dollar is getting crushed because they're printing so much currency, what are you going to do, right? Your earnings are based on this, right? The stock prices are based on U.S. currency. So you start to experience inflation in asset prices, and the question becomes, do your stock prices outperform the inflation rate? So if the true inflation rate is 15%, are you going to get a 15% gain in your stocks? And if you did, you just broke even, right? So that's important to understand. But anyway, I just wanted to show this real quick and get it out there again. I think we are heading into a recession. It doesn't mean you need to go unload your home and everything. And it might depend on where you live, of course, right? You don't want to be stupid with your money, but at the same time, I'm talking to a lot of people on here. I don't know where every one of you are located. Maybe you're located in an area in Florida, right? And real estate's probably going to do okay in a lot of those areas. But if you're in San Francisco, or you're maybe in Las Vegas, or maybe even, well, Miami is actually not even as bad right now, but there are a lot of areas, Coeur d'Alene, Idaho, or Boise, Idaho, you're going to be facing some real problems, especially as these interest rates continue to climb. But anyway, that's all I got for now. Make sure you like the video if you think it helps you at all looking at these charts. Also, if an ad pops up, just watch an ad. It's free content. Might be a 5-second ad, 15-second ad. And the ads have nothing to do with what I pick. They just are based off your own search history. But anyway, I'm going to get out of here and get this video posted. So I will catch you on the next one.